So this is Market Mondays with Cory, Boldroff, the real estate guy. I wanted to give a big overview about what's going on in the market, kind of how the coronavirus is affecting the market, short and long term. And I wanted to do a really in-depth look and kind of give you guys stats and facts. So I'm uh, making my computer accessible and sharing my screen, and that way I can kind of show you guys exactly with real facts, real stats, real articles, and you can kind of see where I'm getting my information. This is going to probably take about a half hour, 45 minutes. So I suggest coming back or maybe skipping through it to different sections that you want. The things that we're going to be talking about is the top questions that everyone's been asking, kind of what you heard on the TV, the news, the media, from different real estate professionals, mortgage experts, economic experts. So we kind of put together those 5 top questions, and we're going to go over those answers. When is the economy going to recover? Are we going into a recession? Is this going to be like 2008? What about all the job losses? And what are the major indicators to watch for? So first we're going to go through of when is the economy going to recover? Well, right now we have to understand that this really wasn't a true recession that we're headed into or something that's going to affect the economy long term. It wasn't like a tornado where it came through, destroyed a bunch of businesses, destroyed a bunch of housing, and now we got to rebuild that infrastructure up. Nothing's really broken. We just kind of put it on pause. The government said, hey, wait, everyone stop going to work and stay home, safe at home, and let's get ahead of this virus. Let's beat this hidden enemy. So we have to understand that this is really just a pause on it. Before we went into this pandemic, the economy was doing very strong. The key indicators, we were at our all-time low unemployment rate. Our work participation rate, meaning if you wanted a job and you're willing and able to have a job, you more than likely had a job. Now, I do know that a lot of people say, oh, well, everyone has 2 jobs. Well, the last administration put it on to businesses that if you work more than 30 hours, you have to provide health insurance. And by doing that, the business now has to incur a $2,000 to $3,000 expense. So that's why business decided, okay, well, I'm going to give you 29 hours and I'll give him 29 hours. So now you have to have 2 different jobs to have that same amount of hours. I have a feeling that if that is lifted, businesses will go back to hiring 40 hours a week. So I do believe health insurance is a good thing to provide for people, but you can't mandate and force businesses to do it, knowing that it's going to add an extra expense to them, and a lot of times it'll put them out of business. The major financial institutions are actually calling and predicting a V-type recovery. So we did head down pretty rapidly and pretty severely in this last 2 months because we basically put the whole economy on hold and said no one's allowed to go to work, and businesses, we had to stop selling, and people go on unemployment. So it did go down rapidly, but of the 3 major institutions, they are all seeing a V shape that we're going to actually go up almost at a faster rate than we came down. So if it took us 2 months to cause us where we are today, it's going to be less than 2 months to get back out and get back to where we were before, and maybe even superseding where we were before. Historical analysis shows that pandemics are usually V-shaped, sharp recessions that recover quickly enough to provide little damage to home prices. And some very cutting-edge search engine analysis by our information management team show that the current slowdown is playing out similarly thus far. It's worth looking back at history to place the potential impact of COVID-19. In fact, these shapes monopolize the empirical landscape of prior shocks, including the epidemics such as SARS in the 1968, H3N2 the flu, the 1958 flu, and the 1918 flu. All had similar V-shape effects. So are we going into a recession if we're not already in one right now? Well, first of all, I want to say that recessions do not equal housing crisis. Actually, in the last 3 of 5 recessions, we've actually had an increase in the residential market or in the housing market, and one of them was a very slight downtick. Now, granted, 2008, but that was a housing crash. That was a mortgage-caused housing crash. that therefore caused the recession, caused a lot of people to lose their jobs and the housing market to come down. With the exception of two recessions, the Great Recession from 2007 to 2009 and the Gulf War recession from 1990 to 1981, there was no other recessions that impacted the U.S. housing market, according to Fannie Mae Home Price Index data created from 1975 to 2018. Is this going to be like the 2008 crash? Well, I've done a video just on this, but I want to highlight on a couple of things and show a couple of graphs. Many still bear the scars from the Great Recession, and many expect the housing market to follow a similar trajectory in response to the coronavirus outbreak. But there are distinct differences that indicate the housing market may follow a completely different path. While the housing led the recession in 2008, 2009, this time they're predicting that we're actually going to help us bring it out of the recession. The housing market crash in 2008 was accompanied by the SP 500 correction going down by 50%, and housing prices depreciated almost 20% in a 3-year period, which is a huge decrease in housing prices in that shorter period of time. We're not experiencing that at this point in time. What 9/11 has in common with what is happening today is that this shock has also generated fear and anxiety amongst the general public. People avoided crowds then, and as they believed another terrorist attack was coming, are acting the same today to avoid getting sick. The same parts of the economy are under pressure: airlines, leisure, hospitality, restaurants, entertainment, consumer discretionary services in general. And then .com and 911 crash, we actually saw the SP 500 come down by 40%, but the annual appreciation prices actually increased during this time. The annual housing appreciation, I've talked about this before, in 2000 to 2008, really, we had an unhealthy appreciation rate by 8.5%, 12.5%, and sometimes 25 to 50% in some housing markets. So it was almost an artificial appreciation caused by anybody and everyone allowing to get mortgages. So the mortgage index to be able to afford or to be able to get a loan was the easiest it's ever been in the history of our time. Over the last 5 years or 6 years, we've gone up by a healthy 3.5% to 5% in a lot of markets. So again, we're at a much healthier spot than we were in 2008. This is kind of what I was talking, the mortgage credit availability index. The taller the graph, the easier it is to get a loan. You can see in 2004 to 2006, it was the highest we've ever had in the history of our time. It came down severely, which is actually what caused the housing market and the mortgage crisis, is they allowed anybody and ever to get a loan, and all of a sudden in 2006 and 2007, or beginning of 2007, they said, nope, you're not allowed to get a loan, and we're going to raise interest rates. And so it went. So you can see we haven't loosened up, and it's still really hard to get a mortgage. You have to be really well qualified to get a mortgage. Now, first-time home buyers, there's a little bit of an exception. There's a little bit looser guidelines, especially in California, because they want to help people become homeowners, because they do understand that that is one of the true indicators of building wealth in this country. Months of inventory and home sales. So in 2007, we were sitting on 8.5 to 9 months, the average months of houses were sitting. Right now, we're about 3.1. So we're at a lot less sitting on the market. Total home equity crashed out. So I also talked about this, but we were refinancing by the billions. 2005, 6, and 7, we were taking out an unprecedented amount of money out of our houses, and we're using it for luxury items, cars and motorhomes and vacations. Now, in the last 3 years, it hasn't been anything like that. We've actually been at a 1% increase, which is the lowest it's been. It's at crisis levels. So mortgage banks actually, they make their money by people refinancing and adding to that principal, restating those loans and getting that 30-year fix, because the interest is what they make it. So right now, interest rates are going down, so they're making less and less money per mortgage, and the principal is not going up. So we're actually in a crisis where we need to be refinanced. We need to pull this cash out so the banks can reinvest that money. Also, what I suggest is when you pull that cash out, you put the money into a bank, into a long-term annuity account, an interest-bearing account. Now, if you do come in hard times, you have that money for the peace of mind and the safety for you and your family. If it's in your house and we have a housing crash, or they all of a sudden make it even harder to get loans or rates go up, you can't access that cash, and therefore you'll be in a position where you might have to do a distress sale. So please, if you're not thinking about selling this summer, please, I beg you, and I don't make any money from this. This isn't an alternative motive for me. Please go refinance. Go to your lender and refinance and pull some cash out. Pull out 6 months to a year worth of mortgage payments put it into your bank, so you have that as a safety net. More so, take out a little bit extra. That way, if we do come into another housing crash, you can be one of those investors that buys at low points and waits for the next tick up, and you can make that appreciation growth. That is how true wealth is made in this country. Right now, we're at the all-time high. So 53% of Americans owe less than 50 or have more than 50% of equity in their homes. 37% actually own it free and clear. Those are the baby boomers. These have been the people that have been in their homes for the last 20, 30, 40 years. They own their home outright. We need them to sell their homes. But the only way they're going to be able to do that is they have the new, like the condos and the townhomes and the smaller single homes come up on the market, and they're just not happening right now. Also, what's going to help with this is the new ADU laws that are going to allow senior citizens either to build an ADU for themselves or to build one for a tenant or a different sector of the market. 26% of mortgages have at least 50% of equity. This is one of the highest times. This is again for the people that have bought in the last 7 to 10 years, decided to maybe do those 15-year mortgages and owe a lot less than their house is worth. And accompanied with, we've had a healthy state of appreciation. So even if you just bought 5 years ago, you probably have a lot more equity than you possibly think. The percentage of median income needed to purchase a median income priced home. In 2006, it was 25.4% of your income was needed. Right now, we're at 14.8%. So actually, housing is more affordable than it was in 2008, despite what you want to hear and what you want to think. Also, I really want people to understand that rental prices have gone up exponentially. In 2008, you could probably rent a 4-bedroom house for $1,800 in Los Angeles County. Right now, it's probably about $2,800 to $3,200 and maybe even higher depending on your market. So you're actually saving money by buying rather than renting. So if you're telling yourself, I can't afford to buy, that is just not the truth. Please call me and I can show you how you actually save money by buying, and you'll be putting money into a long-term savings account instead of into the round bin or into your landlord's pocket or paying their mortgage. What about all the job losses? So this isn't a normal job loss situation. We aren't in a situation where businesses were going out of business, where companies weren't able to afford to keep their employees covered. This was the government saying, hey, businesses, you have to shut down temporarily. So therefore, they obviously had to let their employees go. Now, as the stimulus package comes back, I have a feeling that a lot of people will be brought back onto it. But you can see we've had a huge spike in unemployment, the claims. There is no lie about that. We are at the highest ever in the history of our time of unemployment job claims filed. Blah, blah, blah. Sorry, it's live, guys. So I want to kind of give an indication. So in the first 700,000 of people that went unemployed back in March, this is what the percentage made up. So 59.5% of them were in food services and drinking places. These are the servers, the bartenders. Obviously, once the restaurants are allowed to open back up, they're going to have to bring back these bartenders and servers because they have to keep their businesses open. 4.1% was in construction. So we just started getting new construction. We were at the highest point of new construction permits pulled was this last 6 months. So they had to put it on hold because if it's not essential, if it's not for hospitals and actual housing that was being built for a particular sector, they had to put it on hold. Health workers. So you're saying, oh no, health workers are through the roof right now. Well, actually doctor's offices and a lot of people are closed because people aren't going to the doctor's office, and elective surgeries are at an all-time low because you're not doing those elective surgeries right now. And I think a lot of hospitals, you're not even allowed to. Child daycare workers, obviously they've been unemployed because businesses aren't open, their kids are at home along with their parents. Temporary help services, 7.1%. This is Different sectors, again, they feel that once the economy comes back up, we will need those temporary services to come back. Retail trade, this is again for those in stores that aren't allowed to be open, the Verizon stores, the clothing stores, even Target, that they had to minimize their employees because they're not allowed to let you just walk through it. So as you can see, a lot of these people who went unemployed, once the safer at home gets lifted, they'll be able to go back to work. Again, the major institutions are seeing a V-shaped bounce back and type of recovery. Unemployment rates projections, so they say it's going to be about 15% this year. They're not sure how quickly it's going to come back because it'll just depend on how quickly each state will be able to allow them to come back, and hopefully getting those people who get part of the stimulus check don't sit and say, oh, well, you know, I'd rather just sit at home with a paycheck. I think everyone's going to do the exact opposite and going to be dying to get out there. I do believe jobs give you self-worth. I do believe they give you some self-confidence. And I do believe that during this time, people are going to actually want to go back to work. I don't think it's going to be a position where we sit. But even the projections see that within a 3-year period, we will be back down to unemployment rates at historical lows. Unemployment rates and home sales do not have a direct relationship. So again, this is all about the real estate market. So in 1989, when it spiked up to 7.5%, actually housing and prices were, sales were increasing. When it went up and spiked up to 6% in 2001, you can see housing prices or sales actually went through the roof. 2008 crash, obviously unemployment went through the roof at that point, and housing prices did come down because that was a housing mortgage crisis caused recession and unemployment. We're at 4%, and you can see housing prices or housing sales. I keep saying prices, sorry guys. Housing sales have gone up through, have steadily inclined or increased this last 2, 3, 4, 5 years. Current unemployment rates compared to past financial crisis. So you can see through the Great Depression, unemployment rates were through the roof. To 25% in 1933. 2011, we jumped up to about 8.5%. This last years, we're coming down, so we're not going to be anywhere close to where we were in those heights. Granted, we have to take account that this 15% is really an artificial number. It was a government-caused unemployment. It wasn't an economy-caused unemployment. So what should we watch for over the next several months? Well, one, homeownership is an important source of wealth creation, enabling current homeowners and succeeding generations to move up the economic ladder. Like I said, it is one of the only true indicators of true wealth built in this country. So the sooner and earlier you are able to buy a home, the more homes you're able to buy, the more wealth you actually are able to achieve in your lifetime. More real estate, or more millionaires are made through real estate than any other industry in the whole entire world. My results suggest that in the absence of the panic, the declines in unemployment, consumption, and output in the early stages of the Great Recession would have been significantly less. So please stay off the media. Don't buy them. They're trying to cause fear and hysteria. That's how they get you to keep watching. That's how they keep us divided. So rest assured that we are not coming into a 2008 crisis. We are not coming into this huge crash. The economy is going to bounce back, and I believe it's going to bounce back at historical levels, and so do the great institutions of this. They're banking on it. We can already see an uptick in the stock market happening over this last couple of weeks. Here's a bunch of where we're getting these facts. So again, I will leave this up here. I will give you, if you want, I can send this to you guys by email or through text message, but I'll have all the links on here of where we're getting this information and resources that we've updated. So again, sales over this last, up into February, January, February was the highest January and February in home sales that we've ever had in the history of our country compared to any other January and February. So the buyer demand was through the roof. Now, obviously this last 30 days, it's slowed down, but houses still are selling. People are still getting to escrow. Buyer demand is still there. People still need housing. People still need shelter. So people that are displaced are still looking. So there are still serious buyers out there. Also, there are some investors out there that are trying to look for a good deal. So I suggest don't do a panic sale. If you can just wait 30 days, 60 days, if you're in that position, we are going to see an absolute boom in buyer demand. I believe interest rates will come down even further, increasing buying power, increasing housing appreciation sales prices. Days on the market. So you can see for the general part of it, housing today, we're right under 30 days, which was the average before we hit this crisis. So we're still in that same point. Now, the ones that are high have always been high because there's not a lot of demand to move into those states. Existing home sales, again, we've climbed up pretty steadily through these last 5 years. There's been upticks and downticks, but home sales are still selling. Really, the thing that's driving this is the lack of inventory. So existing home sales, they've increased. New home sales have increased. So these are things to watch out for, is what is the new home sales price. Now this isn't just California, this is over the whole entire nation. So if we do want to look at California, please let me know and I can give you guys an in-depth look at what home sales are doing in California. New home sales are selling fast. We've basically been hovering around 3 to 4 months, dipping a little under 3 months, but the average right now is getting less. And this is completion of sold, so this isn't days on the market. So it takes about 30 to 45 days to go through escrow, and about 30 days from the time you put it on the market to the time it sells. So that is that 90-day period. We're right around there. Now, when you see it dip under that 90 days, that means houses are selling even quicker. Pending home sales, we're at a really historical healthy levels. Pending home sales, again, we're still at good levels. Percentage of distressed properties. Since 2012, the percentage of distressed properties, people that had to sell, got in foreclosure, had to sell, short sale, had to close, trusts and probates, they're going down significantly. We went from 35% to 2% in January. So those people are saying we're going to wait. That's probably not a good idea to wait, because we're actually going to have an appreciation this year and possibly even next year. So if you wait, you're just going to wait for interest rates to go up, which will affect your monthly payment. Home prices, again, I think we just went over this. This is just all a bunch of information, kind of looking at the change. We're seeing in California, they're actually estimating a 10% increase over year from last summer till now. The increases are going to be about 10% in some markets. Our housing inventory, we're at a severe housing crisis. If you're in California especially, we need inventory, guys. So if you're thinking about selling, now is the great time, because you don't have a lot of competition. You can get more for your house. You don't have to negotiate as much. You don't have to give as much. It's still important to price it right. Remember my theory? Get the hype, build the hype. The best way to build the hype is to price it low, and then to make sure that you're giving access to people that you're not giving to the rest of the public. People want what others can't have. People want what others want, and people want what they're feeling they're getting a good value for. Months of inventory sales. So again, I'm just going to skip through some of these graphs. Year over year, we're at historical lows. Again, our inventory, this is really what's driving our market in California. We're at historical lows for inventory levels. Okay, that is why we have the new ADU laws, why new construction is through the roof, permits for new construction is through the roof, and why I keep urging people to put their houses on the market. Now, I do believe baby boomers over the next 3 to 5 years are going to start putting their houses on the market. I think they're going to start moving out of California. I think they're going to start wanting to downsize, or they'll move into an ADU or build an ADU. So I do think those are going to affect our inventory levels. Housing to supply, this is again over the last 12 months, and you can see we've gone down, 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 down. We need more houses. New homes, we're pretty steadily in the last 12 months. An increase, new home inventory. Buyer demand, this is what I keep saying. Buyer demand over the last 5 years has grown, okay? We had a couple spikes, but it's still growing, okay? People still need it. And right now we're growing really fast because the interest rates have lowered. Foot traffic, buyer index, interest rates. So this is again where it's important to watch interest rates. We started at 3.9%, and over the last couple months, last 12 months, we've come down to 3.3. We actually dipped in the end of February, beginning of March. We dipped to a 2.875, which is one of the historical lows. I do believe we're going to go back there. So if you're a buyer and you don't need to buy right now, again, it doesn't help me by saying this. I think you should wait till the safer at home is lifted. I think you should wait because I do believe interest rates are going to go down lower. Actually, I should change that. Let me rephrase that. I think you should actually buy now because the house prices will be lower than they are going to be this summer. And then over the summer when the rates drop, just refinance your house. Sorry, mortgage people, because they get penalized for when you do this. If you refinance within 6 months of getting the loan, they're actually penalized. Just use that same person to do the refi and they'll be able to recoup some of their losses. 30-year fixed, again, we're at all-time lows. I think we're going to dip back down here, back into that rate right there. Mortgage rate projections. So this is the projection that they think it's going to lower, into that third quarter, and then stay kind of steady through the election period. Okay, that's where mortgage rates. These are just more of their things. Mortgage credit availability. So right now, the mortgage credit availability has been hard. Okay, we don't have historical debt. So here, this is the graph that I was trying to show. We went up to 800%. It was easy to get a loan. Now it's hard. Now we've slowly been finding ways in different programs through a secure and standard loan system where we can, okay, so if you're self-employed and your gross adjusted income shows that you write off a lot of expenses, we know that that's not truly an indicator that you can't afford it. So now they're allowing like 12 months bank statements or 24 months bank statements to show we do make the money, we do have it. It's just we like to capitalize on our write-offs. So that is kind of one of the things that we're doing. And then first-time home buyers, they are getting more aggressive with allowing programs such as 3% down payment assistance, the closing cost assistance, all great programs that are government insured to leverage the risk and limit the risk of the mortgage banks. Average days to close. So like I said, we've been right around 45 days. That's kind of the new norm. We did spike up to 51 days before this just because there was a huge demand in buyers at the time, and then we've lowered back down to 43 days. FICO score requirements, last 12 months. This is for a paper, basically getting the very best 30-year mortgage, fixed rate mortgage that you can get, is right around 720 to 730. Now, you can get, as a first-time homeowner with a 640 credit score, you can get 97.5% financing. So 96.5% financing. So don't be fooled that you have to have a 720, but your credit will affect your mortgage payment and your mortgage rate. FICO score distribution. So you can see that 50% of people have a FICO score that is 750 and lower. Right now, this is like your first-time home buyers. This is kind of the majority, but right now we're at an all-time high for FICO. So the FICO people have been credit worthy this last 5 years and really found ways to building their credit. If you do need help, let me know. I have a couple of tricks and hacks that can help raise your score within like a 30, 60, 90-day period to put you in a position to buy before the end of the summer. The average FICO score, so again, the FHA, the average is 678. They will go down to a 640. I think they even have a program that goes down to 580. There's just limits what you can get approved for. VA 711 and conventional 755. Your back end at DTI, so this is what the debt to income. So your total debt, your housing, taxes, insurance, principal, and interest, plus the debts that are on your credit score. This is that DTI compared to what your income is, your gross income. So conventional is 36%, FHA is 44%, and VA is 42%. So that's where I say VA or the FHA has gone a little higher and been a little bit more aggressive because it is a government insured loan, and usually it's first time home buyers that truly don't have higher incomes at that point in time. So that is the gist of my coronavirus real estate update. I hope you guys find this useful. If you want me to go over anything or you want me to send you this PowerPoint presentation, please let me know. Again, I'm here just to be a valuable resource of information and provide service to you. So even if you're planning to use me or not, please share this with people. Please get this information out there. It is very, very important, especially right now, to calm people, to bring that anxiety level down, and to bring and to myth bust those media that are trying to cause hysterical and fear, and maybe those entrepreneurs or those real estate professionals who have never sold real estate in their life or haven't been in the market in the last 20 years. They just came in 2 years ago and don't really understand what's going on. So please let me know if I can be of any service. Please let me know. And again, I want everyone to be safe and healthy. I hope everyone's family is safe and healthy. And my heart goes out to anyone that was affected by this, anyone that has a loved one lost. I know it's happening out there, and I'm very, very sorry for those that it's happening to. If there's anything that I can do to help, please let me know. I have access to resources that most people don't. So reach out to me if you need help with anything, groceries. Maybe you just need someone to talk to. I have resources for you. And I have resources starting at home, okay? I have 6 kids that would love to talk to people, and I would love for someone else to take care of them for 2 minutes. No, I don't mean that, but you kind of know what I mean, guys. I'm just trying to be real here. So again, I truly hope this is useful. Please like it, share it. Look on my YouTube channel. I have a lot of good resources and videos out there, and I'm going to constantly be putting a lot of content out there in the next 2 weeks that are hopefully adding to this valuable resources. So again, I promise to provide 5-star service and the ultimate client experience. And the first place I'm going to do it is by showing you that I care and to come from a place of service, whether you're using me or not. Till next time, stay safe and healthy.